All right, guys, so this is part two of Activision. Part one, we took a look at their earnings call, and in this episode, we are going to take a look at their financial documents. So if you guys want to learn more about the company, definitely check out episode one. But if not, you can definitely start off with this episode. So like always, we're gonna start off with the income statement. So here in the income statement, we take a look at some important numbers here. The most important ones are revenue, cost of revenue, gross profit, earnings per basic share, and net income. So here we're gonna take a look at quarterly numbers because this was quarter one. So it's better to take a look at quarterly numbers opposed to annual numbers since annual numbers have yet to be released. So quarter one, we can see had $1.8 billion of revenue, and this was a decrease compared to same time last quarter, where same time last year was almost $2 billion. So that's about a $0.2 billion decrease in net revenues. So we can definitely see why this company has decreased in price for stock, as this company is collecting less revenue as it was same time last year. Cost of revenue has decreased though. We're sitting at 563 million compared to same time last year at 662 million. But of course, if you are collecting less revenue, you are expected to pay less for that revenue cost. Gross profit, we're sitting at $1.26 billion compared to the same time last year was which 1.3 billion. So even though revenue itself decreased by almost 0.2 billion, gross profit has not decreased that much. It's only about 0.05 billion. So this company is definitely doing really good to maintain its money. Earnings before income tax, here we can see values. There's nothing different here. But one thing to take a note at is Activision seems to be a very cycle run. It seems quarter four and quarter one seem to be, actually, it seems that quarter one seems to be the strongest quarter of all. If we take a look at all these past numbers, it seems quarter one usually has the highest value to it. Last quarter, quarter four, they did have a big jump, but I'm pretty sure quarter four of last year was when they sold Destiny back to Bungie. So they definitely collected a lot of money during that term. But we can see here earnings before income tax. Right now we're sitting at 570 million compared to same time last year, sitting at 595 million. So like I said, right, even though revenue is almost $0.2 billion lower, earnings have not decreased dramatically. Next, we're taking a look at net income. Net income right now we're sitting at 447 million compared to the same time last year, 500 million. Again, about a 30 million decrease. But like I mentioned, compared to that 200 million decrease in revenue, these numbers have not gone down that much. Earnings per basic share right now is sitting at 58 cents compared to the same time last year at 66 cents. So definitely this decrease has definitely helped the stock go down in price, but is it worth it? At the moment, looking at this income statement, I don't think it's worth that. This decrease in revenue and everything does not seem like a huge reason for the stock to drop that much. So if you took a look at last episode, we were taking a look at their guidance for the year. So let's take a look at their guidance to see how they compare. So for quarter two of coming up, they expect to have 1.3 billion dollars of revenue, whereas same time last year was actually 1.6 billion dollars in revenue. So that's actually even lower than the revenue gap between these two. So that's about 0.3 billion dollars less compared to right now, where it's $0.2 billion more. So again, we continue to see that decrease in net revenue. So that's definitely gonna take a toll on this company. And now that I'm taking a look at it, now this financial guidance, again, the decrease in revenue from this quarter to last quarter same year, and then again a decrease for anticipation for next quarter compared to previous quarter. Those two alone can definitely drive this price of the stock to go down. So then they also mentioned earnings per share would be about 21 cents. 21 cents, same time last year was 53 cents. That's definitely a huge drop in earnings per share. And like I mentioned, this can definitely take a toll on the company as a whole. Now they also gave us 2019 guidance. They're saying about $6 million, $6 billion in net revenue, where same time where last year was $7.5 billion. So that's about $1.5 billion less. And if we take about a look at quarter one and quarter two, that means quarter one and quarter two only were $500 million less. So that means quarter three and quarter four are gonna be a total of $1 billion less of revenue provided between those two quarters. So again, that is definitely a huge drop, and they have earnings per share sitting at $1.18 compared to last quarter sitting at $2.38. But now that we took a look at that, let's take a look at previous years. So even $6 billion in revenue is actually lower than 2016. So that's again pretty scary. But when we're taking a look at earnings per basic share as well, $1.18 are worse than 2015. So we can definitely see what's driving down investors to sell out of the company. All right, guys, so next we'll take a look at the balance sheet. And to me, the balance sheet is usually the most important document for me to take a look at. I can really see everything that's going on within the company in these few charts. So first, we can see total assets. So total assets as a whole, we can see in the past few quarters have been around this 18 billion mark. So we can see right now it's sitting at 17.95, but we can see it's sitting around its average where it's at. So assets are not growing. Not definitely a bad thing. I would definitely love to see assets grow, but we'll take a look at their distribution in a bit to see how assets are moving, like what's decreasing, what's increasing, or is it pretty much flatline. But I really like these two charts to my left, total liabilities and total debt. We can see there has been a huge drop off in both of these. So with assets maintaining a flat value and liabilities dropping down, that means only one thing, and that's shareholder equity is going up. So the amount that shareholders hold is increasing. So you can see total liabilities right now are sitting at 6.35 billion. It is almost a 1-to-3 ratio, a little bit a 3-to-1 ratio, more like 2.5-to-1 ratio, and those are really good numbers in my opinion. We can see total debt here is being paid off in pretty huge chunks, and like we saw in the last episode how this debt is broken down in years, and the next payment they have to do I think is 2021. So 2 years from now they have to pay off this debt. So hopefully we don't see any increase in debt, long-term debt, over the next few years. But it's definitely a good thing to see that they're definitely paying off their liabilities. Here in receivables, this is money they're collecting either through some form of credit. This is credit cards or any other payments. Right now it's sitting at 594 million, and it's pretty high. It's higher compared to its previous of same time last quarter. So they are collecting more money compared to the same time last year. So that's definitely a good thing. And payables right now is sitting at $166 million. This is money they have to pay to their suppliers and the people providing them with their items. And we can see even payables has decreased to 166 million compared to same time last year, sitting at 172 million. Not a big drop, but it's still good to see. That means this company is being more efficient with the way they create their items. Cash and cash equivalents is sitting at a huge $4.7 billion, and that to me is really good news. That means cash and cash equivalents can pay off its total debt. It's almost a 1.5-to-1 ratio, and those are really good numbers when we take a look at total debt. So this company definitely has plenty of time to live. We can see based on its total debt, its total liabilities, and its assets that this company is not going off anywhere, and that's great news. So then here we're taking a look at Lazy FA. They also give us some more charts, and here we can see shareholder equity, which, like I mentioned, is the difference between assets and liabilities. And we can see total shareholder equity just keeps increasing and increasing. We have on this nice uptrend. That's definitely a great thing to have as a shareholder. Right now, shareholder equity is sitting at about $10.35 billion. And like I mentioned, that's total liabilities and total debt is almost sitting at a 2.5 to 1 ratio. Next, we'll take a look at asset distribution and liability distributions. So here we can see assets and the asset distribution. This is something I don't like to see, where intangibles make a huge portion of the assets. And here we can see intangibles make 65% of the total assets for this company. But there's, even though it makes up this much, I mean, we got to remember this is a software or a video game company, so a huge amount of their assets are the content, are their characters, World of Warcraft, the title, Hearthstone, the title, Overwatch, the title. So just the titles of all this company, Blizzard as a whole, Activision as a whole, the Call of Duty franchise. So all these names are worth something. So when, again, this is just like Netflix, where Netflix has huge intangibles because they are a media company. So all these shows are worth some random value. Obviously, you can't price them properly, but I give the same mindset to video game companies, because it's pretty much the same thing. They are a media company in the video game side. So here, obviously, those titles mean money. But this is one thing I like. Remember how we saw that assets were pretty flatlined throughout the past few quarters, but intangibles as a whole have decreased and are continued to decrease. So that means this company is losing assets and intangibles, but since it has been flatlined for the past few quarters, that means we're gaining assets in other places. And we can see a huge place where we're gaining that asset is through cash and cash equivalents. And again, here in liability distribution, we can see this company has paid off a huge portion of its non-current debt. Its non-current debt is worth about 70% of the total liabilities for this company. But remember, just cash and cash equivalents can easily pay this off. So again, those are great numbers, and I'm really liking the balance sheet of Activision. The revenue, the income statement was a little iffy, but seeing the balance sheet gives me some hope, and I think I would be leaning into buying shares on Activision. But let's continue. It's too early to tell. Let's take a look. So now we take a look at net cash flow from operations, and net cash flow from operations is sitting at 450 million on the positive, and this is the only cash flow I care about. I really don't care about cash flow as a whole, free cash flow, because that's something that can be manipulated pretty easily with investing, financing, and all those numbers. But net cash flow from operations mean just the net cash flow from its everyday use. And if a company can survive doing this, then that's all the money they need. So here right now, sitting at 450 million. Same time last year was 529 million. So again, not much of a decrease compared to same time last year, even though revenue has dropped. And the previous year before that were actually higher than 2017. So this is definitely good to see. Even though revenue has dropped, not a big hit has been taken in net cash flow from operations. Finally, the last thing we're going to take a look at are some metrics. So here, price to earnings ratio. So this price to earnings ratio was the price when the company announced earnings. I think at the moment was around 40 something dollars. But here we can see it's almost at its pretty low compared to previous values. And we can see here in the quarter when the stock price was sitting at about $60-$70, price to earning ratio was in the 100 values. So we can see that definitely showed us that this company was a bubble ready to burst. And it did burst down, and we had that $20-$30 decrease in price, which meant about almost a 40% decrease from its all-time high. But here right now we're sitting at a respectable level of 19.5 PE ratio. Next, we'll take a look at debt to equity ratio, and we can see this debt to equity ratio is going down, and that can only mean two things. One, debt is going down, and two, equity is increasing. So both of those are good things. So whichever one is happening is definitely a good for the company. I am happy that we're below a 1.0 ratio, almost a 0.5 ratio. So the company has almost double the equity compared to debt. So that's shareholder equity. So shareholders own double the amount that the company owns in debt, and that's again great numbers. Sales per share continue to increase. And current ratio, so current ratio is our current assets divided by current debt. And usually here you want to see a ratio above 1, and we're sitting at a ratio above 2 points, about 2.5. We're sitting at 2.6 current ratio. So that to me, this company again has plenty of money to pay off any current debt, and we saw its cash and cash equivalents. This company has plenty of money to pay off any long-term debt. So as a whole, this company is definitely doing a really good job at managing its money. Gross margin is sitting at about 65, 69%, almost 70%. And we can see this is pretty much the average it's been sitting at. So that's good to see. We don't see any fluctuations going on. And again, profit margins as well. Profit margins are sitting at about 24.5% compared to the same time last year, 25.4%. So again, if we take a look in these past few quarters, not a huge jump. Nothing crazy volatile going on there. So that's definitely a good thing to see. So yeah, that's it for Activision. And to me, I definitely would give this company a buy. Honestly, I'm not usually one to go for a retail based company where they sell video games. But this company as a whole is definitely doing pretty good. The main things that drove me into wanting to buy Activision are first, the balance sheet. We can see this balance sheet doing pretty good where this company is paying down its liabilities and total debt at a huge level. Then we saw that cash and cash equivalents is worth enough to pay off its company's total debt. It's worth enough to pay over 75% of the company's total liabilities. Again, and then income statement is definitely a slowdown in income statement, but this company, as we saw in the last episode, this company is strengthening its profile by going stronger on its strong franchises. And like I mentioned in the last episode, I feel like a company should always strengthen up what they're strongest on. So always do bet if you're strong at one thing, continue to do that because that's where you're winning at, and you want to win some more. I believe that's always the first thing to do before strengthening your weaknesses. And then cash and cash flow statement, this company has plenty of money collected and it's on a positive cash flow. And then when we took a look at the metrics, that PE ratio, we're sitting at a good price, around 20 PE ratio. This could definitely increase at the moment as the price is now sitting at 45. But to me, Activision is definitely a buy. So I'm going to take a look and adding that to my portfolio. So take care, guys. Have a good night. Let me know what you guys thought about the episode. Let me know if you guys want to see another stock. Post on the comments to let me know what stock you guys want to take a look at. Take care and have a good night.